The strengthening of the Iraqi dinar is not merely a technical monetary decision. It is a profound symbol of renewal, sovereignty, and resilience for a country that has endured decades of conflict, instability, and economic hardship. The revaluation of the dinar carries with it implications that extend far beyond exchange rates. It is about a nation's ability to reclaim its place in the global economy, to give its citizens a sense of pride and purchasing power, and to send a clear message to the international community that Iraq is stepping into a new chapter. The dinar has for years been at the center of speculation and debate. Investors around the world have long questioned whether Iraq's vast natural resources, particularly its oil reserves, justified a stronger currency than the one that circulated in markets. For much of that time, the dinar was dismissed as an improbable candidate for revaluation, largely because the country's political and economic structures were not yet aligned to support such a move. The announcement of its revaluation represents not only a change in financial mechanics, but a shift in how Iraq wishes to be perceived on the global stage. For the Iraqi people, this revaluation is a deeply personal matter. After years of currency instability, black market exchanges, and the constant erosion of household purchasing power, a stronger dinar provides a tangible benefit. Everyday citizens can buy goods and services with a renewed sense of confidence, reducing the psychological toll of watching their national currency undervalued for so long. For business owners, importers, and exporters, the adjustment changes the calculus of costs, profits, and risks. Contracts written in foreign currencies now have to be reconsidered, and businesses dealing in imports find that their purchasing power abroad has improved. This creates an immediate sense of relief and opportunity, even if the long-term effects will depend on broader economic management. On a national scale, Iraq's revaluation is an assertion of independence. For years, the dinar was often viewed as tied too tightly to external pressures, whether from sanctions, foreign oversight, or oil dependency. The symbolism of revaluation also extends to Iraq's relationship with its diaspora and international partners. Many Iraqis living abroad have long lamented the weak value of their currency, which made remittances more complicated and often less impactful for families back home. Of course, revaluation brings with it challenges that must be carefully managed. A stronger currency can raise expectations among citizens that prosperity will arrive quickly, but without sound fiscal and monetary policy, those expectations can lead to disappointment. Iraq must ensure that the gains from a stronger dinar are not squandered through mismanagement or corruption. The government will need to implement complementary reforms, diversifying away from oil dependency and investing in infrastructure, education, and innovation. Otherwise, the revaluation risks being seen as a symbolic gesture without lasting economic substance. Sustainability is the ultimate test, and Iraq's policymakers must prove that the new strength of the dinar is rooted in real economic fundamentals. For global markets, the revaluation of the dinar is a reminder that monetary transformations are possible even in places long considered unlikely. Currency traders, financial institutions, and multinational corporations are now adjusting to a reality where Iraq's currency cannot be dismissed as speculative. The shift forces a recalibration of risk models, investment strategies, and trade pricing. Contracts that once assumed a weaker dinar must be rewritten, and new opportunities open up for those willing to engage with Iraq on the basis of its new financial stature. In this way, the revaluation has ripple effects across the international system, altering how Iraq is perceived and how other emerging market currencies may be evaluated. The social and psychological impact of revaluation is equally significant. For Iraqis who have lived through years of devaluation, inflation, and uncertainty, a stronger dinar is not simply about money, it is about dignity. National pride is tied closely to the value of a country's currency, and for Iraqis, this shift represents a moment of recognition that their nation is capable of moving beyond its troubled past. This collective sentiment reinforces trust in institutions, encouraging greater participation in formal banking systems, and reducing reliance on informal or black market mechanisms. Such changes are vital for building a sustainable financial system that supports long-term development. At the international level, the revaluation positions Iraq as a case study in how a country can reclaim financial sovereignty after prolonged instability. It shows that revaluation is not only a technical adjustment, but a strategic decision that reshapes a nation's identity and future trajectory. Iraq's move encourages other nations in similar positions to consider how currency strength can serve as a tool for national renewal, though it also underscores the necessity of pairing monetary shifts with real structural reforms. The credibility of the revaluation ultimately rests not on the announcement itself, but on Iraq's ability to sustain it through discipline, transparency, and growth-oriented policy. In the broader narrative of global economics, Iraq's revaluation of the dinar represents a turning point. It redefines the country's role in the world economy, shifts the dynamics of trade and finance in its region, and challenges the assumption that certain currencies are permanently confined to weakness. For Iraq, the dinar is no longer simply a unit of exchange, but a declaration of intent, a sign that the nation is determined to rise, to stabilize, and to take control of its future. For investors and policymakers worldwide, the strengthening of the dinar is a reminder that currencies are not just numbers on a screen, but reflections of resilience, vision, and the determination of people and governments to shape their economic destinies. The revaluation of the Vietnamese dong has become a milestone that symbolizes Vietnam's economic maturity and the recognition of its transformation from a low-income developing economy into one of the fastest-growing and most dynamic players in Asia. For decades, the dong was viewed primarily as a managed instrument designed to keep Vietnam competitive in manufacturing and exports. Its low valuation was both a reflection of the country's early stage of development and a deliberate policy choice to ensure that Vietnamese goods remained affordable on global markets. Over time, however, this undervaluation came to be seen as inconsistent with the underlying progress of the Vietnamese economy, which has steadily expanded, diversified, and integrated into the global system. The recent revaluation represents not just a monetary correction, but a broader acknowledgement that Vietnam has outgrown its old economic profile and now deserves recognition for its achievements. The transformation of Vietnam's economy has been remarkable. Once heavily reliant on agriculture, Vietnam has repositioned itself as a manufacturing hub, producing electronics, textiles, footwear, and increasingly high-tech goods for export. Global corporations such as Samsung, Intel, and Apple have invested heavily in Vietnam, building factories and supply chains that have turned the country into a critical link in global production networks. Foreign direct investment has surged year after year, supported by Vietnam's political stability, skilled workforce, and advantageous geographic location in Southeast Asia. These structural shifts have fundamentally altered the country's economic profile, making the argument for a stronger currency increasingly persuasive. The revaluation of the dong reflects the reality of Vietnam's robust trade performance. The country has consistently maintained strong trade surpluses, with exports outpacing imports across multiple sectors. This has helped Vietnam accumulate significant foreign currency reserves, giving it the financial cushion needed to support a stronger exchange rate. A revalued dong demonstrates to global markets that Vietnam is confident in its ability to sustain competitiveness even without relying on an artificially low currency. It signals that the country is ready to move from being known solely as a low-cost manufacturer to being recognized as a balanced, innovation-driven economy. The implications of this revaluation are far-reaching. For Vietnamese citizens, a stronger dong improves purchasing power, making imported goods and services more affordable. This helps households stretch their incomes further, especially as Vietnam's middle class continues to expand. For businesses, particularly those engaged in importing raw materials and advanced technology, the revaluation lowers costs and opens new opportunities for growth. On the flip side, exporters may face challenges as their products become more expensive on global markets. But Vietnam's rising productivity, improved logistics, and focus on higher value industries provide a cushion against these pressures. The revaluation is therefore not just a challenge, but also an incentive for Vietnamese businesses to climb further up the value chain and compete on quality rather than price. For global investors, the strengthening of the dong is a powerful signal. It confirms that Vietnam is no longer just an emerging story, but a central player in the regional and global economy. It assures investors that the government is committed to stability, modernization, and long-term growth. This enhances Vietnam's appeal as a destination for capital, not only in manufacturing, but also in services, real estate, and technology. The revaluation also aligns Vietnam more closely with other regional economies that have undergone similar transitions, such as South Korea and Taiwan, both of which experienced currency strengthening as their industrial bases matured and their economies integrated more deeply with global trade. The revaluation also carries geopolitical significance. As Vietnam asserts itself through a stronger currency, it demonstrates to its partners and competitors alike that it is no longer dependent on being a low-cost economy. This enhances its negotiating position in trade agreements, bilateral partnerships, and regional forums such as ASEAN. It also provides Vietnam with more credibility in its economic relationships with larger powers such as the United States, China, and the European Union. A stronger dong indicates that Vietnam is prepared to shoulder greater responsibility in the global system, from managing capital flows to ensuring transparency in financial governance. However, the revaluation is not without risks and challenges. Vietnam's government must carefully balance the benefits of a stronger currency with the potential downsides. Exporters, especially in traditional industries such as textiles and garments, may feel squeezed by reduced price competitiveness. Small and medium-sized enterprises that rely heavily on cheap labor advantages could face pressures that force them to restructure or close. Inflation management will also be critical, as shifts in currency value can create ripple effects in domestic markets. For the revaluation to succeed, Vietnam must continue investing in education, technology, and infrastructure to sustain productivity growth and ensure that its industries remain competitive in a world where cost alone is no longer the decisive factor. The sustainability is the ultimate measure of success. The revaluation will only be meaningful if Vietnam can defend the new value of its currency through consistent economic performance and sound policy. This requires prudent management of fiscal policy, effective regulation of the banking sector, and the ability to adapt to global economic shifts. The country's ongoing integration into international agreements, such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, and the Regional Comprehensive Economic Partnership, RCEP, provides it with the framework to expand trade and investment ties, further solidifying the foundation for its stronger dong. The symbolic impact of the revaluation is equally important. For Vietnamese citizens, it affirms the progress their country has made since the economic reforms of the Doi Moi era began in the late 90s. The dong's new value reflects decades of effort, sacrifice, and policy choices that have transformed Vietnam from a war-torn nation into one of the fastest-growing economies in the world. For younger generations, it instills a sense of pride and confidence that their nation can compete on the global stage, not just as a supplier of cheap goods, but as a respected and influential economy. The revaluation of the dong, therefore, is not a single event, but the culmination of years of consistent growth and a signal of Vietnam's future ambitions. It marks the beginning of a new phase in which the country positions itself as a mature economic power, capable of shaping not just regional but global developments. For investors, policymakers, and citizens alike, the revaluation is a reminder that Vietnam has moved decisively beyond its past limitations and is now determined to assert its rightful place among the world's rising economies. The revaluations of the Iraqi dinar and Vietnamese dong have created waves of disruption throughout the global marketplace, forcing banks, corporations, investors, and governments to reassess their strategies in real time. Markets that once treated these currencies as little more than speculative instruments suddenly find themselves adjusting to the reality of new valuations that carry immediate consequences for trade, investment, and financial planning. This is not a marginal shift affecting only those directly engaged with Iraq and Vietnam, but a transformation that reverberates across the interconnected global economy, touching everything from commodities pricing to international trade contracts, balance sheets, and currency hedging strategies. For global banks and financial institutions, the sudden adjustment of the dinar and dong requires a comprehensive recalibration of their models. Both currencies were long regarded as relatively stable at low values, anchored either by external management or by deliberate policy choices. Their revaluations mean that entire systems of forecasting, risk assessment, and portfolio allocation must be reconsidered. Currency desks must adapt quickly to the new rates, rewriting contracts and revising projections that once assumed prolonged undervaluation. Institutions that previously dismissed these currencies as peripheral are now faced with clients seeking exposure, protection, or speculation, creating an unexpected surge in demand for services tied to the dinar and dong. For multinational corporations, the implications are equally significant. Companies with operations in Iraq and Vietnam suddenly face altered cost structures. Importers in Iraq benefit from improved purchasing power, making it cheaper to acquire goods, raw materials, and technology from abroad. Exporters, however, may find themselves challenged as their goods become relatively more expensive in global markets, potentially narrowing their competitive edge. In Vietnam, where manufacturing exports form the backbone of the economy, corporations must now navigate the shift carefully. Those producing higher value goods such as electronics or industrial equipment may be able to absorb the impact, but sectors dependent on low-cost competitiveness, such as textiles or footwear, will need to accelerate their shift toward innovation, efficiency, and branding. These adjustments filter upward into global supply chains, influencing the pricing of consumer goods around the world. The revaluation also disrupts trade flows and bilateral relationships. Contracts denominated in dollars, euros, or other foreign currencies must be recalculated to reflect the new strength of the dinar and dong. Governments and trade partners will need to renegotiate agreements or adjust expectations regarding imports and exports. This creates short-term friction but also presents opportunities for Iraq and Vietnam to secure more favorable terms in negotiations. For instance, Iraq may leverage its stronger currency in oil sales and long-term infrastructure contracts, while Vietnam may use the opportunity to pivot toward trade that emphasizes quality and innovation rather than simple cost advantages. Investors, particularly those operating in emerging markets, are also experiencing a paradigm shift. The revaluations force a reevaluation of portfolio allocations, risk exposure, and opportunity recognition. Where once the dinar and dong were largely considered speculative bets with uncertain timelines, they are now part of mainstream discussions about emerging market currencies that warrant attention. Hedge funds, sovereign wealth funds, and individual investors alike are recalibrating strategies to account for the new values, with some seeking to capitalize on early opportunities while others move to protect themselves from volatility. The effect cascades into broader emerging market sentiment, with investors considering whether other undervalued currencies may follow similar paths, thus reshaping global capital flows. The shockwaves also extend to governments and central banks beyond Iraq and Vietnam. Regional neighbors are compelled to respond to the shifts in competitiveness, trade balances, and currency relationships. In the Middle East, Gulf states that engage heavily with Iraq in trade and energy must now factor in the new purchasing power of the dinar. In Southeast Asia, countries that compete with Vietnam for foreign investment and export markets will have to reassess their own strategies. This could spur debates about monetary policy adjustments, fiscal reforms, or renewed efforts to attract capital. The ripple effect underscores how one nation's monetary decision can influence broader regional dynamics, intensifying the interconnectedness of modern economies. Commodity markets are another arena where disruption is evident. Iraq's strengthened dinar, tied closely to its role as a leading oil exporter, changes the landscape for energy pricing and contracts. A stronger currency provides Iraq with leverage in negotiations, potentially altering the terms under which oil is traded and sold internationally. This has downstream effects for global energy companies, importers, and even consumers. Similarly, Vietnam's stronger dong affects its agricultural exports and manufactured goods, creating adjustments in pricing that flow through international markets. From coffee and rice to electronics and apparel, global buyers must adapt to new realities in cost and value. The psychological dimension of market disruption is equally important. For years, many observers dismissed the possibility of significant revaluations in Iraq and Vietnam, treating speculation as unrealistic or unfounded. The fact that both currencies have now shifted fundamentally challenges those assumptions and forces market participants to reconsider their perceptions of what is possible in the global financial system. This change in mindset opens the door to new speculation, not only about Iraq and Vietnam, but about other emerging markets where currencies are undervalued relative to economic fundamentals. This creates an atmosphere of heightened attention, volatility, and opportunity, drawing even more capital and interest into emerging market currencies as a class. Technology and financial infrastructure also feel the impact. Digital payment systems, cross-border remittance platforms, and even cryptocurrency markets must adjust to reflect the new values of the dinar and dong. For example, remittances into Iraq now carry different weight, altering the economics of money transfer businesses. In Vietnam, digital platforms facilitating e-commerce or supply chain finance must adapt their algorithms, contracts, and pricing models to align with the stronger dong. These technical disruptions highlight how deeply integrated currency values are with modern financial systems, requiring rapid adaptation to maintain stability and continuity. Ultimately, the revaluations of the Iraqi dinar and Vietnamese dong illustrate the profound ways in which a shift in currency values can disrupt and reshape the global economic landscape. The ripple effects spread through banks, corporations, investors, governments, supply chains, commodity markets, and even technology systems. They challenge assumptions, force recalibrations, and create both risks and opportunities across multiple layers of the financial ecosystem. The disruption is not a temporary shock, but a structural shift that will continue to unfold as market participants grapple with the implications and position themselves for the new realities that these stronger currencies represent. The sustainability of the revaluations of the Iraqi dinar and Vietnamese dong stands as the central test that will ultimately determine whether these historic currency shifts become lasting milestones or temporary events overshadowed by volatility and instability. A revaluation by itself is a powerful symbolic move that reshapes global perception, but its endurance depends entirely on the underlying fundamentals of the economies it represents. For Iraq and Vietnam, this means that policy, governance, and structural reforms must align with the newfound strength of their currencies, ensuring that the valuations are backed by real, measurable progress rather than temporary optimism or speculative momentum. In Iraq's case, sustainability begins with its ability to diversify beyond oil dependency. For decades, the Iraqi economy has relied overwhelmingly on petroleum exports, which account for the majority of government revenues and foreign exchange earnings. While the revaluation of the dinar reflects optimism about Iraq's future, that optimism will only translate into resilience if Iraq can create alternative streams of growth. Investment in infrastructure, agriculture, technology, and services must accelerate so that the economy does not remain vulnerable to fluctuations in global oil prices. Without this diversification, the dinar's new value could be challenged whenever the energy sector faces downturns, exposing Iraq to inflationary pressures or fiscal deficits that erode the strength of its currency. Equally important for Iraq is governance and institutional strength. A stronger dinar requires investor confidence, and investor confidence is built on transparency, stability, and the rule of law. Iraq must address corruption, bureaucratic inefficiencies, and political instability that have long undermined its economic potential. If the government can demonstrate consistent fiscal discipline, manage public debt responsibly, and foster a regulatory environment that attracts foreign direct investment, the dinar's revaluation will be seen not as a speculative anomaly, but as the reflection of genuine structural improvement. Without these efforts, however, the dinar risks becoming overvalued relative to its fundamentals, leading to imbalances that could destabilize the economy over time. Vietnam faces a different but equally complex set of sustainability challenges. The revaluation of the dong acknowledges Vietnam's success in becoming a global manufacturing hub and one of Asia's fastest-growing economies. However, maintaining this momentum requires Vietnam to continue moving up the value chain. Relying solely on low-cost labor is no longer sufficient when the currency strengthens, as higher costs can erode competitiveness in traditional industries such as textiles and footwear. To sustain the dong's value, Vietnam must deepen its commitment to innovation, technology, and high-value industries such as electronics, semiconductors, renewable energy, and advanced manufacturing. By improving productivity and emphasizing quality, Vietnam can ensure that its exports remain attractive even as its currency appreciates. Macroeconomic management will also be critical in Vietnam's path towards sustainability. A stronger dong brings benefits in terms of purchasing power for imports, but it also creates risks of inflation, capital inflows, and asset bubbles. The Vietnamese government and central bank must carefully balance monetary and fiscal policies to prevent overheating while continuing to support growth. Foreign reserves must be managed prudently to provide a cushion against external shocks, and the banking sector must be strengthened to withstand volatility. By maintaining discipline in these areas, Vietnam can prove that its revaluation reflects enduring strength rather than short-term enthusiasm. Global integration provides another pillar for sustainability. Both Iraq and Vietnam are increasingly tied to international markets through trade agreements, investment flows, and geopolitical relationships. Iraq's stronger dinar gives it an opportunity to negotiate more favorable terms in oil contracts and infrastructure deals, but it also imposes a responsibility to meet international standards of governance and transparency. Vietnam, as a member of agreements such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership and the Regional Comprehensive Economic Partnership, has committed itself to high levels of market openness and cooperation. Sustaining a stronger dong requires honoring these commitments while leveraging them to expand trade and attract investment in sectors that strengthen the economy's fundamentals. This social dimension of sustainability cannot be overlooked. For Iraq, the benefits of a stronger dinar must translate into real improvements in the daily lives of citizens. If the gains of revaluation are concentrated among elites or squandered through mismanagement, public discontent could undermine stability and confidence in the currency. Expanding employment opportunities, improving public services, and ensuring that economic progress is widely shared will be essential in maintaining the legitimacy of the revaluation. Similarly, in Vietnam, the revaluation must reinforce the aspirations of a rapidly expanding middle class. If citizens see their purchasing power rise and their standard of living improve, confidence in the dong will grow stronger. If, however, inflation erodes these benefits, skepticism could emerge, threatening the sustainability of the new valuation. Investor psychology plays a vital role as well. A revaluation is only sustainable if global markets believe it reflects long-term fundamentals. Both Iraq and Vietnam must continuously demonstrate their ability to defend the new value of their currencies through consistent performance. This requires not only sound domestic policies, but also effective communication with global markets. Governments must project credibility, competence, and commitment, reassuring investors that the revaluations are not one-time shocks, but durable adjustments that align with the trajectory of national growth. External risks present additional tests. Global economic downturns, fluctuations in commodity prices, geopolitical conflicts, or shifts in trade dynamics can all challenge the sustainability of revaluations. Iraq, positioned in a geopolitically sensitive region, must navigate these risks with resilience, ensuring that its economy can withstand shocks without undermining the dinar. Vietnam, heavily integrated into global supply chains, must be prepared to adapt to shifts in demand, technological disruption, or trade disputes that could affect its export-driven growth. Both nations must build flexibility into their economic strategies, enabling them to manage external pressures without compromising the integrity of their currencies. The broader lesson of sustainability is that revaluation is not an endpoint but a beginning. A stronger currency raises expectations and imposes new responsibilities. For Iraq and Vietnam, the challenge now is to prove that their currencies' enhanced values are grounded in lasting structural strength. By diversifying economies, ensuring sound governance, managing macroeconomic risks, expanding integration, and sharing benefits with their citizens, both nations can demonstrate that the historic revaluations of 2025 are not fleeting events, but enduring transformations anchored in resilience and vision.